Study Session 8, Financial Reporting and Analysis, on Financial Reporting and Analysis section. This study session examines financial reporting for specific categories of assets and liabilities. Inventories, long-lived assets, income taxes, and non-current liabilities are examined in greater detail because of the effect on financial statements and reported measures of profitability, liquidity, and solvency. For these items in particular, the analyst should be attentive to chosen accounting treatments, corresponding effects on reported performance, and the potential for financial statement manipulation. Reading 27, Inventories. Reading 28, Long-lived assets. Reading 29, Income taxes. Reading 30, Non-current or long-term liabilities. Readings 27, Inventories. Learning outcome, distinguish between costs included in inventory costs and costs recognized as expenses in the period in which they are incurred. Describe differences, different inventory valuation methods. Calculate and compare cost of sales, gross profit, and ending inventory using different inventory valuation methods. And using perpetual and periodic inventory systems. Calculate and explain how inflation and deflation of inventory costs affect the financial statement and ratios of companies that use different inventory valuation methods. Explain LIFO, reserves, and LIFO liquidation, and their effects on financial statements and ratios. Converts a company's reported financial statements to LIFO and LIFO for purposes of comparison. Describe the measurements of valuing inventory as at net realizable value and financial statement of ratios. Describe the financial statement presentation and event disclosures relating to inventories. Explain issues that analysts should consider when examining a company's inventory disclosures and other sources of information. Calculate and compare ratios and companies, including companies, and the use different inventory methods. Analyze and compare the financial statements of companies, including companies that use different inventory methods. All right, introduction. Merchandising and manufacturing companies generate revenue and profits through a sale of inventory. Further, inventory may represent a significant asset on the company's balance sheet. Merchandisers purchase inventory ready for sale. For manufacturer, they thus account for one type of inventory, finished goods inventory. Manufacturers, however, purchase raw materials from suppliers and then add value by transforming the raw materials into finished goods. They typically classify inventory into three different categories: raw material, work in progress, and finished goods. Work in progress inventory have started the conversion process from raw materials but are not yet finished goods ready for sale. Manufacturers may report either the separate carrying amounts of their raw materials, work in progress, and finished good inventories on the balance sheet, or simply the total inventory amount. If the latter approach is used, the company must then disclose the carrying amount of its raw materials, work in progress, and finished goods inventory in the footnote of the financial statements. Inventories and cost of sales are significant items for the financial statement, and many companies comparing the performance of these companies is challenging because of the allowable choices for valuing inventories. Differences in the choice of inventory valuation methods can result in significantly different amounts being assigned to different inventory and cost of sales. Financial statement analysis would be much easier if all companies use the same inventory valuation method, or if inventory price levels remain constant over time. If there is no inflation or deflation with respect to inventory costs and thus unit costs were unchanged, the choice of inventory valuation method will be irrelevant. However, inventory price levels typically do change over time. International Financial Reporting Standards (IFRS) permits assigning the inventory cost to inventory cost by sales of three cost forms: specific identification, first in, first out, the FIFO, and the weighted average cost. I'm drinking chocolate milk today. Actually, hot chocolate. Christmas is upon us, so yeah. The choice of inventory valuation method affects the allocation of cost of goods available for sales to ending inventory and cost of sales. Analysts must understand the various inventory valuation methods and the related impact on financial statements and financial ratios in order to evaluate a company's performance over time and relative to the industry peers. The company's financial statement and related notes provides important information that the analyst can use in assessing the impact of the choice of inventory valuation methods on financial statements and financial ratios. This reading is organized as follows. Section 2 discusses the costs that are included in inventory and costs that are recognized as expenses and the periods in which they are incurred. Section 3 describes inventory valuation methods and compares the measurements of ending inventory, cost of sales, and gross profit under each method. And when using periodic versus perpetual inventory systems, Section 4 describes the LIFO method, the LIFO reserve, and the effects of LIFO liquidation. And demonstrates the adjustments required to compare a company that uses LIFO with that of the FIFO. Section 5 describes the financial statement effects of the change in inventory valuation methods. Section 6 discusses the measurement of reporting of inventory when a value changes. Section 7 describes the presentation of inventories on the financial statement and the related disclosures to discuss inventory ratios and their interpretations, and shows examples of financial analysts with respect to inventories. A summary and practice problems concludes the reading. Cost of inventory, the IFRS, or under IFRS, the cost to incur inventories are all costs of purchase, costs of conversion, and other costs incurred in bringing the inventories to their production and condition. The cost of purchase includes the purchase price, the import and tax related duties, transport, insurance during transport, handling, and other costs directly attributable to acquisition of finished goods, materials and services, trade discounts, rebates, and similar items reduced the price paid, and the cost of the purchase. The cost of the conversion includes costs directly related to the price of to the unit product. Both IFRS and US GAAP includes the following costs of inventory: abnormal costs occurred in the result of waste of materials, labor, or other production compensation inputs, and storage costs. This excludes costs that are treated as expenses and recognizes only income statements in the period in which they are occurred. Incurring costs and inventory defers the recognition of the expense on the income statement until the inventory is sold. Therefore, including costs in inventory that should be expensed will overstate profitability in the income statement and create an overstated inventory value on the balance sheet. Inventory valuation methods. Generally, inventory purchase costs and manufacturing conversion costs changes over time. As a result, the allocation of total inventory costs between cost of sales on the income statement and inventory on the balance sheet will vary depending on the inventory valuation method used by the company. As mentioned in the introduction, inventory valuation methods are referred to as cost formulas and cost flow assumptions under IFRS and US GAAP, respectively. If the choice of methods result in more cost being allocated to cost of sales and less cost being allocated to inventory than would be in the case with the other methods, the chosen method will cause the current year's reported gross profit and net income and inventory carrying amount to be lower than if alternative methods have been used. Counting for inventory, consequently the allocation of costs, thus has a direct impact on financial statements and their comparability. Before IFRS and US GAAP allows companies to use the following inventory valuation methods: specific identification, first in, first out, FIFO or FIFO, and the weighted average cost. US GAAP allows companies to use additional methods, last in, first out, or LIFO. FIFO and LIFO, a company must use the same inventory valuation method for all items that have a similar nature to use. For items with different natures to use, different inventory valuation methods can be used. When items are sold, the carrying amount of the inventory is recognized as an expense according to the cost formula in use. Specific identification is used for inventory items that are not ordinarily interchangeable, whereas FIFO, weighted average cost, the LIFO are typically used. There are large numbers of interchangeable items in inventory. Specific identification matches the actual historical cost of the specific inventory item to their physical flow. The cost remains in inventory until the actual identifiable inventory is sold. FIFO, weighted average cost, and LIFO are based on the cost flow assumption. Under these methods, companies must make certain assumptions about which goods are sold and which goods remain in ending inventory. As a result, the allocation of costs to units sold and the units of ending inventory can be different from the physical movement of the items. Let me drink my chocolate really fast. The choice of inventory valuation method. Okay. Specific identification. The specific identification method is used for inventory items that are not ordinarily interchangeable and for goods that have been produced and segregated for specific projects. This method is also commonly used for expensive goods that are uniquely identifiable, such as precious gemstones. Under this method, the cost of sales and the cost of ending inventory reflects the actual cost incurred in purchases, or the items specifically identified as sold and the items specifically identified as remaining in inventory. Therefore, this method matches the physical flow of the specific items sold and remaining in the inventory to the actual cost. First in, first out, the FIFO method. FIFO assumes that the older goods purchased are sold first and the newer goods purchased or manufactured remains ending in the ending inventory. In other words, the first units included in inventory are assumed to be the first units to sold from inventory. Therefore, the cost of sales reflect the cost of goods in beginning inventory plus the cost of items purchased or manufactured earliest in the accounting period. The value of the ending inventory reflects the cost of goods purchased or manufactured most recently. In periods of rising prices, the costs assigned to the units in ending inventory are higher than the cost assigned to the units sold. Conversely, in periods of declining prices, the costs assigned to the units in ending inventory are lower than the costs assigned to the units sold. Weighted average cost assigns the average cost of goods available for sale, plus purchase conversions and other costs during the accounting period to the units of the sold. Okay. Last in, first out, the LIFO method. LIFO permits only use under USG AAP. This method assumes that the newest goods purchased are the first and oldest goods to be purchased, including beginning inventory, remains in ending inventory. In other words, the last unit included in inventory are assumed to be the first units sold from inventory. Therefore, cost of sales reflect the cost of the goods purchased and or recently the value of the ending inventory. Conversely, the periods of declining prices, the cost assigned to the units ending inventory are higher than the cost assigned to the units sold. Calculations of cost of sales, gross profits, and ending inventory in periods of changing prices. The allocation of total inventory costs between cost and sales on income statements and inventory on the balance sheet will vary depending on the inventory valuation method used by the company. The following example illustrates cost of sales, gross profits, and ending inventory differs based on the choice of inventory valuation methods. Periodic versus perpetual inventory systems. Companies typically record changes in inventory using either a periodic inventory system or perpetual inventory system. Under a periodic inventory system, inventory valuation and cost of sales are determined at the end of accounting period. Purchases are recorded in purchasing account. Purchases account the total purchases and beginning inventory is the amount of goods available for sales during the period. The ending inventory amount is subtracted from the goods available for sale to arrive at the cost of sales. The quantity of goods in ending inventory is usually obtained or verified through a physical count of the units of inventory. Under a perpetual inventory system, inventory values and cost of sales are continuously updated to reflect purchases and sales. Under either system, the allocation of goods available for sale and cost of sales and ending inventory is the same. For the inventory valuation method, use the either specific identification of a FIFO. This is not generally true for the weighted average cost method. Under a periodic inventory system, the amount of cost of goods available. Okay. Using the LIFO method, LIFO method, the periodic and perpetual inventory system will generally result in different allocations of cost of sales and ending inventories. Under either a perpetual or periodic inventory system, the use of LIFO method will generally result in significantly different allocations of cost of sales and ending inventory compared to other inventory valuation methods. When inventory costs are increasing and inventory unit levels are stable or increasing, using LIFO methods will result in higher cost of sales and lower inventory carrying amounts than the use of LIFO method. The higher cost of sales under LIFO will result in a lower gross profit, operating income, income before taxes, and net income. Income tax expense will be lower under LIFO, causing before taxes and net income. Income tax expenses will be lower under LIFO, causing the company's net operating cash flow to be higher. On the balance sheet, a lower inventory carrying amount will result in lower reporting current assets, working capital, and total assets. Analysts can carefully assess the financial statements implications of the choices of inventory valuation methods when comparing a company that use the LIFO method and companies that use the FIFO method. Okay, so example 3 is here. Okay. Comparison of inventory valuation method as shown in example 2. The allocation of the total cost of goods available for sale to cost of sales that the income statement and ending inventory or balance sheet varies under the difference inventory valuation method. In an environment of declining inventory unit costs and constant increasing inventory quantities, FIFO in comparison the weighted average cost of LIFO. Will allocate a higher amount of total cost of goods available for sale to cost of sales in the income statement and a lower amount of ending inventory on the balance sheet. Accordingly, because cost of sales will be higher under LIFO, the company's gross profit, operating profit, and income before tax will be lower. Conversely, in an environment of rising inventory unit costs and constant or increasing inventory quantities, FIFO will allocate a lower amount of total cost of goods available for sales to cost of sales in the income statement and a higher amount of ending inventory on the balance sheet. Accordingly, because cost of sales will be lower under FIFO, a company's gross profit, operating profit, and income before taxes will be higher. The carrying amount of inventories under FIFO will more closely reflect current replacement versus values. Because inventories are assumed to consist of most recently purchased items, the cost of sales under LIFO will more closely reflect current replacement values. LIFO ending inventory amounts are typically not reflective of current replacement values because the ending inventory is assumed to be the oldest inventory and the costs are allocated accordingly. Example 4 illustrates the different results obtained by either using FIFO and LIFO methods for account for inventory. The LIFO method, or the LIFO method, I don't know what it's called, the LIFO method. In the United States, the LIFO method is widely used. Approximately 36% of U.S. companies use the LIFO method. The potential income tax savings are a benefit for using the LIFO method. But inventory costs are increasing. The higher cash flows due to the lower income taxes may make the company more valuable because the value of the company is based on the present value of the future cash flow. Under LIFO conformity rules, the U.S. tax code requires that companies using LIFO methods for tax purposes use that the LIFO method be financial reporting. Under the LIFO method, ending inventory is assumed to consist of those units that have been held the longest. This generally results in the ending inventories with carrying amounts lower than the current replacement costs because inventory cost typically increases over time. Cost of sales would more closely reflect current replacement costs. If in the purchase cost or production cost of inventories are increasing, the income statement consequence of using LIFO method compared to other methods will include higher cost of sales, the lower gross profit, and if the purchase of prices or production costs of inventory are decreasing, It is unlikely the company will use the LIFO method for tax purposes because it will result in lower cost of sales, the higher taxable income, and income taxes. However, if a company has elected to use the LIFO method and cannot justify changing the inventory valuation method for tax and financial reporting purposes, with inventory cost begins to decrease, the income statement, balance sheet, and ratios effect will be opposite to the effects during the period of increasing costs. The U.S. Securities Exchange Commission, the SEC, has proposed the full adaptation of IFRS by all U.S. reporting companies beginning in 2014. An important consequence of this proposal would be the complete elimination of LIFO inventory methods and financial reporting. And due to LIFO conformity rules, the U.S. reporting by U.S. companies as a consequence of the restatement of financial statements to the FIFO method, or weighted average cost method, significant immediate tax liabilities may arise from the year transitioning from LIFO method to either FIFO or weighted average cost method. The LIFO reserve. For companies using the LIFO method, USGAP requires disclosure in a note to financial statements and other balance sheets of the amount of the LIFO reserves. The LIFO reserve is the difference between the reported LIFO inventory carrying amount and the FIFO amount. Method had been used. In other words, the disclosure provides the information that the analyst needs to adjust the company's cost of sales, cost of goods sold, and ending inventory balance based on LIFO methods to the FIFO method. To compare companies using the LIFO and companies not using the LIFO, inventory is adjusted by adding the disclosure or LIFO reserve to the inventory balance that is reported on the balance sheet. The reported inventory balance using LIFO plus the LIFO reserve equals the inventory that would have been reported under FIFO. Cost of sales is adjusted to subtracting the increase in the LIFO reserve during the period. From the cost of sales to the amount of it reported in the income statement. If the LIFO reserve has declined during this period, the decrease in the reserve is added to the cost of sales amount that is reported on the income statement. The LIFO reserve disclosure can be used to adjust the financial statement of the U.S. company using the LIFO method to make them comparable with a similar company using the FIFO method. That's a lot of examples. Okay, LIFO liquidation. In periods of rising inventory unit cost, the carrying amount of inventory under FIFO will always exceed the carrying amount of inventory under LIFO. The LIFO reserve may increase over time as a result of the increasing differences between the older costs used to value inventory under LIFO and the more recent costs used to value inventory under FIFO. Also, when the number of inventory units manufactured or purchased exceeds the number of units sold, the LIFO reserve may increase as the result of additions of new LIFO layers. Units of increasing, and each increase in quantity creates new layers of LIFO layers. When the number of units sold exceeds the number of units purchased or manufactured, the number of units in ending inventory is lower than the number of units in beginning inventory, and the companies using LIFO will experience a LIFO liquidation. If inventory unit costs have been raised from the period before the LIFO liquidation occurs, this will produce an inventory-related increase in gross profit. This increase in gross profit occurs because the lower inventory carrying amount of the liquidated units, the lower inventory carrying amounts are used for the cost of sales, and the sales are at the current price. The gross profits on the unit higher than the gross profit that would be recognized using the more current cost. The inventory profit caused by a LIFO liquidation, however, are one-time events and not sustainable. LIFO liquidation can occur for various reasons. The reduction of inventory levels may be What unicorn may be a side of management controls. For example, labor strikes and suppliers may force a company to reduce inventory levels to meet customer demands in periods of economic recession. When a customer demand is declining, a company may choose to reduce existing inventory levels rather than invest in new inventory. Analysts should be aware that the management can potentially manipulate and inflate the company's reported gross profits and net incomes at critical times by intentionally reducing inventory quantities at liquidation. During economic downturns, LIFO liquidation may result in higher gross profits than would be otherwise realized. If LIFO layers of inventory are temporarily depleted and not replaced by the fiscal year's end, LIFO liquidation will occur, resulting in unsustainable higher gross profits. Therefore, it is imperative to review the LIFO reserve footnote disclosure to determine LIFO liquidation has occurred. A decline in the LIFO reserve from the prior period may be indicative of LIFO liquidation. Inventory method changes. Companies on rare occasions change inventory valuation method. Under IFRS, a change in the method is acceptable only if changes result in a financial statement providing reliable and more relevant information for the effects of transactions or events or conditions or the balance sheet, financial positions. This means that changes is applied to comparative information for prior periods as far back as it is practicable. The cumulative amount of adjustments related to the periods prior to these presented in the current financial statements is made to the opening balance of each affected component of equity. The changes will be reflected in 3 years of financial statements presented. The financial statements from 2007 and 2008 will be restated as if the new method has been used in those periods, and the cumulative effect of the changes of periods of 2007 will be reflected in the 2007 opening balance of each affected component of equity. An exemption of the restatement applies to the impracticable or determinable either the period specific effects or the cumulative effects of the changes. Under US GAAP, the condition to make a change in accounting policy and the accounting for the change in inventory policies are similar to IFRS. US GAAP, however, requires companies to thoroughly explain why the newly adopted inventory adaptation method is superior and preferable to the old method. If a company decides to change from to LIFO to another inventory method, US GAAP requires retrospective restatement as described above. However, if a company decides to change to the LIFO method, it must do so on a prospective basis, and retrospective adjustments are not made to the financial statements, and carry amounts of inventory under the old method becomes the initial LIFO layer of the LIFO adaptation. Analysis should carefully evaluate changes in inventory valuation methods. Although we stated reasons for the inventory change may be better match inventory costs with sales revenue, the real underlying or the income report profits. As always, the choice of inventory valuation method have a significant impact on the financial statements and financial ratios that are derived from them. As a consequence, analysts should be careful considering the impact of the changes of inventory valuation methods on the differences in inventory valuation methods when comparing a company's performance with that of an industry or of its competitor. Inventory adjustments. Significant financial risks can be a result of holdings of the inventory. The cost of inventory may not be recoverable due to spoilage, obsolescence, or decline in selling prices. IFRS states that inventories shall be measured and carried to the balance sheet at the lower cost of the net realizable income. The net realizable income is the estimated selling of the each subsequent period. A new assessment of the net realizable value is made. Reserve is required for a significant sequent increase in the value inventory. The receipt of any write-down of the inventory is recognized as a reduction in the cost of sales. USGAP used to specify a lower cost or market to the value inventories for fiscal years beginning in December of 2016. Inventories measured using other LIFO and retailer inventory methods are measured at the lower of cost or net realizable value. This is broad consistent with the IFRS's. With a major difference, USGAP prohibits the reversal of write-downs for inventory measures of the LIFO and retail inventory methods. Market value is defined as current replacement cost subject of upper and lower limits. Market value can exceed net realizable value. The lower limit of market value is net realizable value less a normal profit margin. Any write-down to market value or net realizable value reduces the value of inventory, and the loss in value is generally reflected in the income statement. Cost of goods sold and inventory write-down reduces both profit and the carrying amount of inventory on the balance sheet, and thus have a negative effect on profitability, liquidity, and solvency ratios. However, activity ratios will be positively affected with a write-down because the assets or the denominator is reduced. The negative impact of the same key ratios due to the decrease in profit may result in the reluctance by some companies to record inventory write-down unless there are strong evidences that the decline in the value of inventory is permanent. This is especially true under USGAP when the reversal of write-down is prohibited. IAS 2 or inventory does not apply to the inventories of producers or of agricultural and forest products and mineral products, nor the commodity brokers. These inventories may be measured but not net realizable value according to the well-established industry practice. If an active market exists for these products, the quoted market price of the market is the approximate basis for determining the fair value of that asset. If an active market does not exist, a company may make a market demand, price, or valuation. When available for determining fair value, changes in the value of inventory and recognized in the profit or loss in the period of change. USGAP is similar to IFRS in its treatment of inventories of agricultural and forest products and mineral ores. Mark-to-market inventory accounting is allowed for bullion. Analysts should consider the probability of an inventory write-down because the impact of a company's financial ratio may be substantial. The potential of inventory write-downs can be high for companies in industry where technological absence of inventories is a significant risk. Analysts should carefully evaluate prospective inventory impairments and their potential effects on the financial ratio. When debt covenants includes financial ratios requirements. The breaching of debt covenants can have significant impacts on a company. Companies that use specific identification weighted average costs or FIFO methods are more likely to incur inventory write-downs than companies that use the LIFO method. Under LIFO method, the oldest cost of the and reflected in the inventory carrying amount on the bank balance sheet. Given increasing inventory cost, the inventory carrying amount under LIFO method are already conservatively presented at the oldest and lowest cost. Thus, it is far less likely that inventory write-downs will occur under LIFO, and if a write-down does occur, it is likely to be a lesser magnitude. Evaluation of inventory management. The choice of inventory valuation method impacts the financial statements. The financial statement items impacts includes cost of sales, gross profit, net income, inventories, current assets, and total assets. Therefore, the choice of inventory valuation method also affects financial ratios that contain these items. Ratios such as current ratios on assets, gross profit margins, and inventory turnover are impacted. As a consequence, analysts must carefully consider inventory valuation methods differences when evaluating a company's performance over time, or when comparing its performance with the performance of the industry or industry competitors. Additionally, the financial statement items and ratios may be impacted by adjustments of inventory carrying amount and net revisable value of our current placement costs. Presentation and disclosure. Disclosures are useful ways to analyze a company's IFRS requires the following financial statement disclosures concerning industry inventory. The accounting policies adopted by measuring inventories, the total carrying amount of inventory, and the carrying amount for classifications. The carrying amount of inventory carried for fair value, less than cost to sell, the amount of inventory recognized as an expense, the amount of write-downs of inventory recognized as an expense, the amount of reversal of any write-down that is recognized as a reduction in cost of sales and potential, the circumstances of events that lead to reversal of a write-down of inventories, and the carrying amount of inventories pledged as securities for liabilities. Inventory-related disclosures under US GAAP are very similar to disclosures above, except it requires F and G is not relevant because US GAAP do not permit reversals of prior year inventories. Inventory ratios. Okay, so we have a few inventory ratios, I think. Okay, financial analysis illustration. Here's some examples. Okay, summary. The choice of inventory valuation method, the formula or cost flow assumption can have potentially significant impacts on inventory carrying amounts and cost of sales. These are in turn impacted other financial statement items such as carrying assets, total assets, gross profit, and net income. The financial statements and accompanying notes provide important information about a company's inventory accounting policies, and the analyst needs to correctly assess financial performance and compare it with that of another company's. Key concepts of this reading are as follows. Inventory are a major factor in the analysis of merchandising and manufacturing companies, such as companies generate their sales and profits through inventory transactions on a regular basis. An important consideration in determining profits for those companies is measuring the cost of sales with inventories are sold. The total cost of inventories comprises all costs of purchase, costs of conversion, and other costs incurred in bringing the inventories to the present location and conditions. Storage costs of finished inventories and abnormal costs due to waste are typically treated as expenses in the period in which they occurred. The allowable inventory valuation method implicitly involves different assumptions about cash flows. The choice of inventory valuation method determines how the cost of goods available for sales during the period is allocated between the inventory and cost of sales. IFRS allows 3 inventory valuation methods: first in, first out, weighted average cost, and specific identification. The specific identification method is used for inventory items with no ordinary interest, interchangeable for goods and services products, and segregated for different projects. US GAAP allows 3 methods above plus last in, first out. LIFO method. The LIFO method is widely used in the U.S. for both tax and financial reporting purposes because of the potential income tax savings. The choice of inventory method affects the financial statements and any financial ratios that are based upon them. As a consequence, the analyst must carefully consider inventory valuation method differences when evaluating a company's performance over time or in comparisons to industry data or industry competitions. competitors. A company must use the same cost formula for all inventories having a similar nature and use to the entity. The inventory accounting standards, or perpetual or periodic, may result in different valuations of cost of sales and ending inventory when the weighted average cost of LIFO inventory valuation method is used. Under US GAAP, companies that use LIFO methods must disclose in their financial note the amount of LIFO reserve or the amount that would have been reported in inventory in the LIFO method had been used. This information can be used to adjust reported LIFO inventory and cost of goods sold balance to the LIFO method for the comparison purposes. LIFO liquidation occurs when the number of units is entering inventory declines from the number of units that are present at the beginning of the year. If inventory unit costs have significantly risen from year to year, this will produce an inventory-related increase in gross profits. Consistency of inventory costing is required under both IFRS and US GAAP. If a company charges an accounting policy, the change must be justifiable to apply retrospectively to the financial statement. As exception to the retrospective restatement in which a company reported under US GAAP changes to LIFO method. Under the LIFO method, inventories are measured at the lower of the cost of net realizable value. A net realizable value is the estimate selling price of the ordinary course of business less than the estimated cost necessary to make the sale. Under revisable value, depending upon the inventory method used, market value is defined as current replacement cost, subject to the upper limit of the net realizable value and lower limits of the net realizable value less a normal profit margin. Reversals of previous write-downs are permissible under IFRS but not under US GAAP. Reversals of inventory write-downs may occur under IFRS but are not allowed to change US GAAP. Changes in the carrying amount within inventory classifications may provide signals of a company's future sales and profits. Revenue relevant information with respect to inventory management and future sales may be found in management decisions and analysis to similar items with the annual or quarterly reports, industry news and publication, the industry economic data, the inventory turnover ratio, number of days of inventory ratios, the gross profit margin ratio, and useful in evaluating the management of a company's inventory. Inventory management ratios, number of days in inventory ratio, the gross profit margin ratio are used to evaluate management of a company's inventory. Inventory method may have a substantial impact on the company's activity, profitability, liquidity, and solvency ratios. It is critical for the analyst to be aware of industry trends and management institutions. Financial statements discloses provides information regarding the accounting policies and adopting and measuring inventories. The principles uncertainties are regarding the use of estimates relating to inventories. The details of inventory carrying amounts of costs and the information can greatly assist analysts in their evaluation of company inventory management. Okay, so I think this is reading 27, right? So I have finished reading 27. I hope my readings have been helpful. And we will continue reading 28 in our next section, still on financial reporting and analysis. And I hope to see you guys there. Let me turn there real fast. So I do hope my readings have been helpful, and you have been gaining something, and my talks about what I'm drinking that day have been funny. So reading 28, we're going to be talking about long-lived assets. So I hope my readings have been helpful, and I hope to see you guys next time. Good.